All right. Well, I'm going to talk about a few different things today. Most of it will focus on prices and how we kind of navigate crop in storage as we move through the end of 2025 and into 2026. And so, when we're looking at this, I do want to end up quickly touching on some of the macro data, what's going on in terms of commodity prices in general, and then also spend a little bit of time on input prices. I know that's a primary concern. It's really adversely affected profitability in the row crop sector, and it obviously has ramifications when we look at livestock. Livestock prices are have been pretty good. We'll leave it up to Andrew to end up explaining what's going on there, but input prices is something that affects all of our producers, so we do want to end up being aware of what's going on. And then I do want to talk a little bit about how we can handle futures and basis risk, particularly for the crop that's held in storage, and then go through just a couple of quick strategies that we should have at least some consideration when we're looking at it. When we look at this vegetative drought index, I always put this up there. I think it's a very useful tool when we look at what's going on, both from a livestock standpoint, but also from a crop standpoint in terms of how things have progressed over time. One of the big challenges that we've had recently is obviously a lack of government data that's ended up coming in. So one of the ones that I do want to kind of caution everybody on is we will see a bunch of this data. I think the 14th is when they're going to release some of the crop production data and the WASDE reports. That has the potential to end up actually having some pretty sharp reactions depending on what the data ends up saying. Because if you think back, we haven't had an update in over a month on some of that. So again, that's something that there's a high degree of uncertainty when we look to the 14th as to what's going to end up coming out, and then how quickly they're able to get out some of that data. And the ones that I'm particularly interested from a crop standpoint is what's going on in terms of yields, both in Tennessee and national average. That's going to give an indication of our production. And then also on the export side, have we seen some of these large purchases start to materialize? Obviously, China's the big one, but there's a whole bunch of other countries that we have trade agreements or trade understandings with that it'll be interesting to see if that does show up, particularly for soybeans, cotton, and corn, in the data that is released as we move forward. And so just a quick macroeconomic update. Again, we'll circulate all these slides, but the two numbers that I really want to focus in on is that inflation rate. And again, we've seen that tick up so that the latest estimate is 3%. And then also the unemployment rate at 4.3% is also up. And if we think why that's important, is again what the Federal Reserve will end up looking at are those two key metrics to end up determining whether they're going to drop additional interest rates in 2026. And so when we look at that inflation rate getting above 3, that's going to help at least give them some emphasis to put the brakes on further interest rate reductions. But that increase in unemployment rate to 4.3% is going to end up giving them an incentive to maybe lower that. So it'll be very interesting to see what they do, particularly early in 2026 with interest rates. I think the consensus right now would be that they're probably going to drop interest rates another quarter of a point early in Q1, but we'll have to wait and see what some of this additional data ends up showing. If you want to see some of the numbers that I think are a little bit more concerning, again, these delinquency rates for the current quarter, it can be an indication of softening of potential consumer spending, because if we think about things like credit card delinquencies, that's going to potentially be an indicator that consumers don't maybe have the disposable income that they did even a quarter or two ago. When we look more quickly to the commodity inputs, I do want to end up highlighting kind of where we are currently versus a year ago versus the 3-year change across the row crop sector, and then at the bottom portion of this graph, what's going on in terms of input prices. I don't think this is going to be news to a lot of people, but we are way down from where we were 3 years ago. But we have seen row crop commodities come up a little bit. We'll talk a little bit about what some of those reasons are and what it looks like moving forward. When we look at kind of input prices, again, we've seen them up year over year. And so we'll take a quick look at where we are in terms of input cost structure at the end of this presentation for 2026. Just to quickly remind when I'm talking about what prices are doing, I did want to just quickly provide some basic definitions. in terms of cash prices. That's our delivery price. If we go to our local elevator, whoever's purchasing that and doing an immediate sale, the futures price is going to be the Chicago Board of Traders CME price for corn, soybeans, and wheat. For cotton, it'll be the ICE price. The futures price, we'll talk a little bit about deferred and nearby contracts. And then basis is that difference between cash price and the futures price. And so we always want to look through it through that lens in terms of, yes, the cash price is ultimately what producers are most interested in, but you manage that price risk very differently depending on if you're looking at futures or basis changes. The other one I just want to reinforce before we step into some of the price data is the difference between the nearby futures contract. That's the one that's closest to today's date without it being in the past. And so then we have the deferred contract as any contract that's out further than that. And what that gives us an indication of is what is the carry in the market from a futures market standpoint. The key thing that when we're talking with producers is we can secure that a cash price, a basis price, or a futures price for today's date or a date in the future. And that is something that is really key when we look at this. We don't necessarily have to deliver it, but we can end up securing that price in the future. So if we have grain in storage, we can set a basis price or a futures price or both for March, for example, if we think that the prices are beneficial to where the market is trending. So when we look at corn prices, this is a December corn. There's a couple of things I want to point out on this slide. The first one is when we're looking at that corn price and we're looking at that 435 range, we have seen that being a level of resistance or support in the past and now resistance currently. And so again, that's one where that's going to be a key point to watch as we move forward to see if we can breach through that level. That would give us an indication of additional upside in that market. If we can't get through that level and continue to maintain it, we could see a little bit of weakness in corn. Now, again, one key statistic that's going to come out is that national average yield. I think that's really going to dictate whether we move higher or whether we end up pulling back into kind of that lower 410 to 425 range. I think that's going to be the number, and we'll look at that on Friday. The other one that I want to point out, and that's in this kind of table that is embedded over top of the chart, is the carry in the market. And so when we look at this, we have our December contract at 432, our March, and then all the way out until next year. But what we want to end up looking at is what is the incentive to end up maintaining that crop in storage, whether it's priced or unpriced. I'll talk a little bit about later, but we want to make sure that we're looking at what is the opportunity for future deliver at the current date and then account for what our storage and interest costs are on that. When we look at soybeans, this is the one that's had the most action or movement recently. And again, I think everybody's probably aware of the importance of China in terms of soybean trade. That's what largely precipitated this movement up over that 1070 threshold, and where we've seen it come up to 1127 is where we were last night. And you can see the carry is not as strong in soybean futures when we look at where we are. The one thing that I will say about corn and soybean markets right now is there's much more risk embedded in soybean markets. There's just a lot of uncertainty that's primarily driven by trade, but also driven by the South American production season, right? And so, one thing that, there's obviously people that are saying, well, if China buys all these beans, we could see prices go, north of $12. That's true. But we all know that can change with one tweet or one soundbite that ends up coming out. We could be back in that 1040 range real quick. And so again, there's just a huge amount of uncertainty that's embedded in soybean prices right now. So I encourage producers to end up managing their price risk, particularly to the downside. I'll talk a little bit about how we can end up doing that. But it's something where I think it's really important. Yes, we want to be optimistic, but we want to make sure that we are practicing prudent price risk management as we have crop in storage. For cotton prices, cotton has just been a complete challenge this year in terms of marketing. We have not seen good pricing opportunities. We continue to see further weakness, and there's really nothing on the horizon that would indicate that we're going to get back into the low 70s at this point in time. We're having a tough time holding, kind of that mid 60 range right now. And the problem is just the lack of demand that's out there. It's really challenging when you read a lot in terms of cotton markets. What the big problem is they've lost so much market share to synthetic fibers. There's just not a strong demand out there. And until we see some movement in demand, we're not likely to see prices get back up into that 70-cent range. And just for those that aren't maybe as familiar with the cotton markets, a lot of our producers will probably looking closer to needing 80 cents for break even. It's going to vary tremendously, but we are well below where profitable prices are in the cotton sector. When we look at basis, again, basis is going to be different across the entire state. This just gives a seasonal basis chart for Memphis. I pulled this one randomly. We do put out that basis publication for the AMS reported locations if you are interested in a basis number that's closest to you. But what I want to just kind of highlight is the seasonal nature of basis, right? And so when we think about this in terms of where we are and what we're gonna do with the stored crop, is we typically bottom out in September, October, and then we see an improvement in basis. And so again, when we're thinking about our commodity in storage, will we end up seeing 20, 25 cents above the board? Every year is a little bit different. This is a 5-year average, but we can end up pulling those individual location basis bids, both for current delivery, and usually they have 1 or 2 months out as well. So it's important to end up staying up to date in terms of where basis is and what some of the historical trends are. And you see something very similar with soybeans when we're looking at that. Obviously, soybeans, because of the emphasis historically on export markets, we do end up seeing it tied very directly to Mississippi River flows. And so that adds another element in there that can adversely affect basis as we move through the marketing year. I mentioned those location-specific bids. AMS puts this out, USDA AMS puts this out on a daily basis. And so if you are interested in looking at different offerings that are out there, what it will end up giving you, it'll give you the location or the region, they'll give you the basis, they'll give you the change, and then they'll give you what that price is and then when your delivery period is. And so it's something, again, we have a tremendous differences depending on where we are in the state of Tennessee in terms of what our cash prices and basis are. A lot of that is driven by local supply and demand and access to river ports. And so when we think about this, it's really important to end up looking at that. If you're in southern middle Tennessee, unfortunately, we don't have a lot of locations that report to AMS. So you might want to end up looking at whether it's Tyson's or whether it's Woodall's, looking at what their offerings are, because that's going to really give you a better indication of what's going on in those individual locations. I mentioned interest costs. This is one that I think is really important for producers to consider. Is yes, you want to end up calculating what that future spread is and what your projected basis is. Again, projecting basis can be challenging because those bids usually only go out a couple of months in terms of what the basis is for that specific contract. But what we want to get to is a price spread and then an estimated interest cost so that we can determine if there is a financial benefit to end up storing that crop or should we sell it and pay down debt, right? And the thing we have to remember is in addition to that interest cost, there's probably an additional 3 to 10 cents per month depending on how you're storing that in terms of capital recovery, in terms of additional handling and trucking costs and shrink and all those things. So again, we do have to end up taking a look and seeing where we're at. One thing that I think we do always have to be cautious with, is where we set our expectations. We can get individual estimates for point in time, but I hear a lot of people saying, well, I think it's going to go to 12. It might, but that is a speculative position. That is not something that's based in the data that we're seeing right now. And so again, there's an inherent risk when you're looking at just straight speculation in terms of movement of prices that I think we need to be cognizant of in terms of how we convey that. When we're making decisions, we need to make decisions on the best available information. And some of that might include, yes, I think prices are going to go higher, but we have to be able to act on the information that we have right now. So I encourage people when we're looking at this, the futures market numbers are what they are. That's what we're going to end up looking at in terms of the opportunity to provide price risk management. What happens in the future is going to be a combination of a whole bunch of factors that are incredibly difficult to predict. Just again, historically, I want to re-emphasize this is just the returns to storage for soybeans if we avoid those harvest lows. This is a 10-year average. Every year is different, but again, if we're talking about in terms of bin or storage, the benefits of it, historically, there's been a real strong incentive to store and put the commodities in storage and then end up selling it in early the following year through spring. So again, it's something where, yes, there's been a historical precedent there. Does it mean that we should store it right everything this year and keep it in storage? No, it does not. We have to look at those opportunities on an individual year-to-year basis. So when we're looking at individual pricing strategies, there's three things I kind of want to talk about. The first, and I'll use soybeans as an example, but we can have strategies for corn as well. The first one is selling that cash soybeans and buying a call option. I'll talk about some of the mechanics behind that. Store soybeans unpriced. I know there's a lot of farmers that are doing this right now. I think that is an incredibly risky endeavor. You expose yourself to fluctuations in both the futures market and basis that are completely outside of your control. Plus you're incurring storage or interest and other storage costs. And so you can go backwards real quick with that strategy. Yes, you can end up potentially capitalizing if markets move higher, but there's a high degree of uncertainty in that one. And then the other one is just establishing price protection, whether it's basis, futures, or both, or using some combination of options to end up protecting that commodity in storage. So the first one that I want to talk about was sell cash soybeans and buy a call option. This is one where, again, it's usually good to end up having some consultation, whether it's with the broker or a grain merchandiser, on the benefits and the disadvantages of these types of strategies. But if you're selling that cash soybeans, I pulled a recent price, 11.30 is what you'd end up selling. So you deliver the soybeans to the elevator, receive the 11.30, buy a March call option at 11.80 for 20 cents. So you'd be 20 cents out of pocket. So your net price would be 11.10, but you'd have upside in the futures with that call option with no downside. And so one of the things that I do like about this strategy is if we did end up getting massive purchases from China, say they came in and they said, we're going to buy 50 million metric tons, double what they've indicated they're going to end up purchasing, and soybean prices went to 12.50, you'd be able to end up gathering an additional 70 cents just through your call position on that. Worst case scenario, you're out the 20 cents that you paid for that call. The other benefit about this one is if you're selling that cash soybeans, you've got that cash flow to end up paying bills, to end up paying off an operating note. And so you're saving that interest cost in terms of having that commodity in storage. So this is one I really do like. I know there'll be lots of people that say, well, I don't want to end up locking in or selling at 11.30 in case it goes to 12, but that call option does give you some upward mobility on that, but it really sets that floor so that we're not having a tremendous amount of price risk in there. The other option, storing soybeans unpriced, again, you are completely subject to positive or negative movements in futures and basis. During that time, you are also incurring interest and other storage costs. So if the market did reverse, go back down to 10.40, not only do you get a lower price, but you've got the interest component that is embedded in your price, and then you don't have cash flow to meet year-end expenses. That can be another challenge. I will say there is one option that we can end up looking to end up generating cash flow, and that's through the marketing loan. Talk a little bit about that at the end. But this is an extremely risky position given the uncertainty embedded in trade that's going on right now. Right now is a key time for production in South America as we move through the end of this calendar year. There's going to be a lot of information that comes out there. And then the other one too, as I mentioned, is we don't have current data that we're trading right now. So when we get this data dump as it comes through at the end of this week and into next week, what is that going to do to markets? It's really difficult to end up projecting what's going to happen. And so when we don't have any price protection on the downside, it really does open us to whatever whims the market ends up presenting over time. The other option is to end up storing and establishing a price. So you can use a basis contract. If you like the basis in your area, set that basis and then fix the futures later. I would be more inclined to fix the futures, let the basis do the work. As we move into the new year, you can do that through an HTA contract or just selling the futures. I do like the use of options. It allows you to set up a price floor and participate if prices end up going high. And so you can use a traditional put option where you're paying a premium, setting a price floor. That way, if it goes up, you can still participate in the market rally, or you can use a combination, which would be a fence. And I know we've talked about this in the past where you're taking a floor price, but you're also establishing a ceiling to reduce that premium cost. And so looking at that one, I think is is a prudent approach as well, because again, what you're trying to do is reduce that premium cost. We'll get some reasonable price range that you're targeting. And then the last one is to take a cash forward price. That's basically just looking out and saying, okay, I can get a cash price for delivery in March of 1160. I'm going to take that, lock it in. We'll deliver it in March. And so working through this, I think, is really important to end up seeing what can we end up doing to mitigate that risk for our crop in storage. When we look at 2025 futures price ranges, again, we're kind of locked in on the corn side, or have been. So I would anticipate us to continue to trade in that range unless we see something dramatic in terms of yield change that the USDA puts out there. Soybeans is just a massive range because of the trade uncertainty that's embedded in there. You can make a pretty strong argument that we could go $1 higher or $1 lower, just based on updated information from a geopolitical standpoint. Cotton, I don't have a ton of optimism that we're going to move out of this kind of mid to lower 60 cent range. There's just not enough on the demand side. And then wheat, when we look at what we've seen, we've been locked in pretty close to that 520 to 580 range. I did have a friend of mine out in West Tennessee send me, this is from the Babylon Bee. It made me chuckle this morning, so I decided to throw it in there. I thought it was kind of clever as we end up exiting the government shutdown. But it is going to be important to see what that data ends up saying and what the reaction is to it. The ad hoc payments, there's rumors that it'll be something similar to MFP, if we remember back to the first trade disruption where there was those payments direct to producers for specified commodities. It sounds like there will be something similar to that. We'll have to wait and see for more information on there. And when we look at one thing that I do want to make people aware of is marketing loans. It's much more widely utilized in cotton, but what it allows us to end up doing is to get cash flow for a commodity held in storage so that we can end up making some decisions, either paying down debt or end up buying additional inputs for the 2026 crop. It's a method to end up generating some cash in the short term so that we can end up covering some of those things. And the major benefit to it is if you enter a commodity into the market, I think the latest number is 5.25%. So if you're operating loans at 8%, you can save, roughly that 3% range. So that's something where it's applied for through the USDA Farm Service Agency office, but that may be something that some producers may want to end up considering, or at least having that conversation with FSA once they end up reopening all the offices and are back up to full capacity. One thing that I do want to emphasize on the row crop side of things, just because of the challenges with profitability we've had for the last couple of years, they need to get out and make sure that they're securing that financing for 2026 as early as possible. It's going to be a challenging season for a lot of people to get those loans renewed and get that financing in place. We do have a meeting on December 1st, one in Martin, one in Jackson. I encourage you to distribute that information out to producers. We will step through some commonly asked questions, provide some resources to end up planning for that loan renewal season, talk a little bit about how to deal with issues in terms of unpaid input supplier lines of credit, operating debt, how a consolidation works, those types of things that I think are going to be really imperative. I really, if there's one message I want to get out to our row crop producers, is do not wait until end of January, February to try to get financing. We need to get out in front of this ASAP because it's going to be challenging for a lot of people. And so the last thing I'll end up closing with is just, it's time to start planning for 2026. I know it feels like we've just barely ended up finishing up the harvest in 2025, and there's still a lot of moving parts with that crop. But it is time to end up starting looking forward. And so the one thing I want to kind of show, I know there's a lot of numbers on this, but I always get questions is how do you end up taking kind of a basic budget and turning it into a marketing plan? And so when we look at this, I took a 2026 corn cost of production budget. We can argue the numbers back and forth in terms of individual categories, but based on what we've got here, we've got a cost of production of $914. And so again, one that I always find useful is if you are expecting a $5 cash price, so futures plus plus basis, how many bushels do you need to cover these individual expense categories? So if you have a seed cost of $116 an acre, you need 23 bushels at $5 to end up covering that cost. And so our break-even yield at $5 is 183 bushels per acre if our cost of production is $9.14. Taking it one step further, you look at when that time of expenses occurred. And so we can look at these different time intervals in terms of when pricing could potentially end up occurring in terms of our input costs, and do we want to match that with a marketing component? And so that's what we're looking at in this final three categories, is how much of our production should we look at pricing at different intervals. And again, these cost structures are going to be different for a lot of different operations, but what I kind of want to get at with a strategy like this is how much should I price at different increments during the production year, right? And trying to look at it from a risk standpoint, because when you make that input purchase, you've established a price component for your cost of production that you may want to consider. Do I want to lay off some risk on the market on the output side of things? And so that's what we're working on this. I'll step through this in a little bit more detail in our workshop out on December 1st. But I think this is an interesting way to end up looking at how do we look at new crop marketing and where there's opportunities as we move forward.